In the previous financial year, Bottles acquired valuable land to generate rental income. From the date of acquisition, the land was rented to Cooldrink for 11,000 Rand per month. On 31 August 2020, the fair value of the land amounted to 1,145,000 Rand. Okay, so what you must take note over here is that Bottles is renting out land to Cooldrink. Okay, so in the books of Bottles would have an investment property. What makes it investment property? So remember, for something to be investment property, it must either be land or buildings, and it must be held with the intention to earn rental income or to earn capital appreciation. So in this case, Bottles have land, which they are holding with the intention to earn rental income. As a result, it is investment property. Now, it would only be investment property from Bottle's perspective when we're looking at the separate financial statements. When we're looking at it from the group perspective, if you picture from a group perspective, just picture this. So we have Bottle, which is a separate legal entity, and we have Cooldrink, which is a separate legal entity. So Bottle is renting out the land to Cooldrink. So from a separate legal entity perspective, the land is correctly classified as investment property. But from a group perspective, Bottles and Cooldrink is one entity. Okay, so if you just picture one big block around Bottles and Cooldrink, which is the group. Okay, so Bottles renting to Cooldrink, from a group perspective, it is basically now considered to be owner occupied. So yes, the group owns the building through Bottles, and the group is using, sorry, not the building, the land. So the group owns the land by virtue of controlling Bottles, and the group is using the land by virtue of Cooldrink renting the land. So therefore, although on a separate entity perspective, the land is correctly classified as investment property in the books of Bottles, but in the books of the group, in the consolidated financial statements, the land cannot be classified as investment property, because now it is not held to earn rental income, but rather it is now owner occupied. Any owner occupied land and buildings has to be classified as PPE. So from a group perspective, what we will have to do is to make adjustments, adjusting journal entries to swap out investment properties. We'll have to from a group perspective, we would have to reclassify the investment property from investment property to PPE, and we'll also have to reclassify any impact on profit or loss. So for example, we will have to reclassify the fair value gains. We'd have to reclassify the fair value gains, and we'd have to recognize so anything relating to investment property, we'll have to reverse, and then we'll have to recognize any like depreciation and so forth relating to PPE from a group perspective. Okay, so just take note of that. So on 1 March 2021, Bottles sold computer equipment to Cooldrink. Bottles initially purchased this computer equipment on 1 September 2020 for an amount of 165,000 Rand. Cooldrink paid an amount of 170,000 Rand for this computer and will depreciate it over the remaining useful life. So that is an intercompany transaction. the whole intercompany transaction would have to be reversed. Okay, so any gain or loss made on that disposal of the equipment and any additional depreciation would have to be reversed. Okay, so they say during the current financial year, Bottles also paid a management fee of 211,000 rand to Cooldrink. Okay, so there are three things from if you can look at it from an intercompany point of view. So it is the reversal, is the reclassification of the investment property and reversing anything relating to investment property that is sitting in the profit or loss. And we would have to then account for the property in terms of PPE within the group. The second thing, we will have to adjust for the intercompany sale of equipment. So generally, there are two types of adjustments over here: reversing reversing the intercompany gain or loss, and then reversing the additional depreciation. And then the third thing is to account for the management fee intercompany transaction. Okay, so that would just simply be to reverse the management fee income in Cooldrink and reverse the management fee expense in Bottles. What you might just take note over here, this management fee has been paid, so there wouldn't be an asset or a liability in the balance sheet. If this thing was still payable, then there would be a management fee receivable, a management fee payable, and that would also have to be reversed. Okay, but in this case, it has been paid, so there's no payable, no receivable, so there's nothing that needs to be reversed on the balance sheet relating to this transaction. Okay, so let's move on. Cooldrink PLC. Okay, so for Cooldrink PLC, this is a foreign company. So remember, foreign subsidiaries is only applicable to CTA 2 level and is not applicable to CTA level 1. So for CTA level 1 student, you can ignore this aspect. Okay. So they say Cooldrink purchased a 60% controlling interest in Cooldrink PLC on 1 July 2021. Cooldrink is a Mozambican company and its functional currency commonly referred to as the Mozambique New Medical, MZN. Cooldrink also manufactures beverages, and the flagship drink is a very popular carbonated strawberry drink. Cooldrink decided to invest in Cooldrink to gain access to Cooldrink's intellectual property. Cooldrink have been trying to perfect their own strawberry drink recipe for a number of years, but to no avail. The imported strawberry drink from Cooldrink has always been more popular in South Africa than the locally produced drink. The consideration paid was as follows. A cash consideration of 620,000 Rand was paid on 1 July 2021 into the lawyer's trust account. Included in the cash consideration paid are acquisition-related costs in respect of valuations and lawyers' fees of 120,000 Rand. Okay, so what's important to take note? This 620,000 Rand includes two things. A cash consideration of 500,000 as well as valuation and lawyers fees of 120,000 Rand. Now, you must be very careful over here because it's included in that amount. What we must know that this is the specific treatment relating to acquisition related costs. Okay, so in this case, that 120,000 Rand needs to be removed from the consideration. So when we work out the consideration, we must not include 620, but we should be including 500 because the 120,000 Rand relating to valuation lawyers fees is not included in the consideration. So just read up in IFRS 10, in IFRS 3 regarding that. On 1 July 2021, Cooldrink issued 3,200 of its own shares to the former owners at a market price of 140 Rand per share. Okay, so here you can see that included in the consideration is shares. The price you must use for the shares must be the market value at the date of acquisition. Sometimes they'll give you more than one market value. So which market value do you use? You use the market value of the shares at the date of acquisition. So the date of acquisition is 1 July 2021. Okay, so if I just track back again, applying the same thinking as I applied for bottles. So Cooldrink purchase 60% controlling interest. So because I have a controlling interest, that implies they have a subsidiary, that implies they will have to consolidate. Okay. So from 1 July 2021, we have to consolidate. Okay, so just take note of that. So let's read on. So according to the purchase agreement, Cooldrink will be liable to pay an additional amount of 150,000 Rand if the market price of Cooldrink shares declines below 120 Rand per share during the first 2 years of the acquisition. Okay, so this is considered to be a contingent consideration. Okay, so if there's a contingent consideration, we must include the market value of the contingent consideration at the date of acquisition. So the total amount is 150. This does not mean that this is the market value at the date of acquisition. This is just the total value that will be paid, but it's not necessarily the market value at the date of acquisition. So we need to take into account the market value at the date of acquisition of this 150,000 Rand that will be payable in 2 years' time if Cooldrink shares drop below 120 per share. Okay. So they're saying according to the purchase agreement, Cooldrink will be liable to pay an additional 150,000 Rand if the market price of Cooldrink shares decline below 120 Rand per share during the first 2 years after the acquisition. At 31 August 2021, Cooldrink share price declined by 5%. The fair value of the contingent consideration was estimated to be 60,000 and 85,000 on 1 July and 31 August, respectively. So take note which amount we include in the consideration. We will include the 60,000 Rand because that is the fair value of this 150 at the date of acquisition. Let's say at the acquisition date, the manufacturing plant of Pink Drink was already very old and required urgent maintenance to ensure the production capacity can be maintained. This was noted in the investment. As part of the purchase agreement, Cooldrink also granted a loan to Pink Drink on 1 July 2021 to the value of 1 million Rand to be used for plant maintenance. The loan bears interest, but settlement is neither planned nor likely to occur in the foreseeable future. Okay, so we will deal with this or how to treat with this. So generally, I just need to confirm, but generally, when you make a loan, when there's a loan of this nature, so they bears interest, but they don't plan on settling the loan, and nor is it likely to occur in the foreseeable future. Right? So in a situation like that, I just need to confirm, but if I remember correctly, when you have a loan of this nature, then a loan of this nature will be included as part of the consideration. Or it will be part of the net assets of the business. Okay, so I'll just confirm how we treat it. Once I do confirm, then I'll re-explain it again. So interest payments will be made annually, and any tax consequences have already been included in the income tax expense for the year. Cooldrink's accounts was uncertain how to account for the loan and the acquisition of a foreign subsidiary, and therefore only recorded the cash outflow in the sundry receivables account. Okay, so we will have to deal with this issue. The trial balance of Cooldrink as at 31 July 2020 was as follows. Okay, so this is 31 August. Sorry, the trial balance of Cooldrink as at 31 August 2020 was as follows. Okay, so this is the opening balance, right? So share capital, retained earnings, trade and other payables, property, plant and equipment, inventory, trade and other receivables, cash and cash equivalents. Remember, we acquired this on 1 July 2021. All assets and liabilities were considered to be fairly valued on 1 July 2021, with the exception of intellectual property. The internally generated brand had a fair value of 860,000 Rand and was not recognized in the financial statements of Cooldrink. The brand name had an estimated useful life of 4 years at the acquisition date. No additional assets, liabilities, or contingent liabilities were identified at the acquisition date. The accountant prepared the following note for the investment in Cooldrink to the annual financial statements of Cooldrink Group for the year ended 31 August 2021. Okay, so let's remember, part of the acquisition method is that we need to recognize we need to identify all assets and liabilities and then measure them at fair value. So what does that mean? The brand is not included in Cooldrink's financial statements. It's correctly not included because it is an internally generated brand name. Okay. So as a result, when we acquire it, when Cooldrink acquires it, they'll have to recognize this intangible. We'll have to recognize this intangible asset. But just take note, this is all MZN will have to convert. Okay. So here we go. Name and description, acquisition date, percentage of voting rights. Okay, they give you the acquisition was made to gain access to the subsidiary's brand name. Control was obtained over the subsidiary through acquisition of the majority of the voting rights. The major class of assets acquired and liabilities assumed as at 1 July 2021 were as follows: non-current assets, current liabilities. Okay, so this is basically equity at the date of acquisition. Then they say note 1, non-current assets consist only of property, plant and equipment of Cooldrink as presented in its separate trial balance. Okay, so just take note of that. Okay, so this is effectively how can I say, this is effectively net assets at the date of acquisition. So take note, this over here is the balances as at 31 August, where this is at 1 July. We need equity at the date of acquisition. Okay, so just take note of that. Okay, so Slim Water Ltd. Cooldrink purchased 25% of the shares and voting rights of Slim Water on 1 April 2018 for a consideration of 1.1 million Rand. From this date, Cooldrink has been exercising significant influence over the financial and operating policy decisions of Slim Water. Slim Water bottles spring water at a fountain in the Maloti Mountains. Okay, so what's important, we acquired a 25% interest on 1 April 2018. This gave us significant influence. So when we have significant influence, it implies we have an associate. When we have an associate, we have to equity account. Okay, so just take note of that. So from 1 April 2018, the group will have to apply equity accounting with respect to the investment in Slim Water. Slim Water had the following equity and reserve balances at acquisition. So here we have share capital and retained earnings. All the assets and liabilities were fairly valued at 1 April 2018. So basically from 2020 onward, Slim Water sold water to Cooldrink. Water is sold at a profit of 40% on cost. Included in Cooldrink's inventory in respect of these sales are 77,000 Rand and 91,000 Rand on 31 August 2020 and 2021 respectively. Okay, so this is basically opening balance, and that is basically closing balance. So from an intercompany transaction, when it comes to inventory, there's basically three intercompany journals that will have to take place when it comes to inventory. So the one, you'll have to remove the sale during the year. Okay, so you remove 100% of the sale during the year. Number two, you must remove the unrealized profit included in closing inventory. And number three, you must remove and recognize the unrealized profit included in opening inventory. So take note what I said. We remove the unrealized profit included in, we eliminate or remove the unrealized profit included in closing inventory. When it comes to opening inventory, there's two things we do. We eliminate and then recognize the unrealized profit. And I'll explain why we eliminate and recognize the unrealized profit included in opening inventory. Okay, so take note, there are three pro forma journal entries relating to the intercompany sale of inventory, removing the sale during the year, removing or eliminating the sale during the year, eliminating unrealized profit. So number one is to eliminate the sale during the current financial year. Number two, eliminate unrealized inventory in the closing balance of inventory. What did I just say? Eliminate unrealized profit included in the closing balance inventory. And number three, which has two parts, is to eliminate and recognize the unrealized profit included in opening inventory. Okay, so during the current financial year, Slim Water also paid a management fee of 120,000 Rand. So once again, same story as above. Slim Water acquired equity investments for the first time during September 2020. The fair value movement on these investments are included in mark-to-market reserve. Okay, on 31 August 2021, so that is the last day of the current financial year, Cooldrink disposed of a 20% interest in Slim Water for 1.6 million. The remaining 5% interest had a fair value of 290,000 Rand on 31 August 2021. Cooldrink classified the remaining investment as a financial asset at fair value through other comprehensive income. Okay, so by them disposing 20% on the last day of the financial year, it means they no longer have significant influence and they only have a normal investment. Okay, so basically they have no influence at all, no control, no joint control, no significant influence. Okay, so therefore they can't have a subsidiary, they can't have a joint operation or a joint venture, and they can't have an associate. So as a result, it is a normal ordinary investment. A normal ordinary investment is basically an IFRS 9 investment. Under IFRS 9, we have one of two choices when it comes to investment in shares. It's either measured at fair value through profit or loss, or it is measured at fair value through other comprehensive income. In this case, they chose to measure the investment at fair value through other comprehensive income. Now, what's important to understand over here, when there is a change in ownership, and the change in ownership results in a change in the nature of the investment. Okay, so listen carefully. When there is a change in ownership, like in this case, it's a change in ownership from 25 to 5%, from 25% to 5%. So that is a change in ownership. Now, if this change in ownership results in a change in the nature of the investment. So in this case, this change in ownership does result in a change in the nature of the investment. Why? The first part, there is a change in ownership. Why? Because we went from 25 to 5%. In this case, also, there is a change in the nature of the investment. Why? Because we went from associate to normal investment. So that means there's a change in the nature. There's a change in the type of investment from associate to normal investment. When we have a situation of that nature, when we dispose, we are deemed to have disposed of our entire investment. So take note, in a situation like this, we are deemed to have disposed of our entire investment. The word deemed is important because we actually only sold 25. We actually only sold 20 and not 25, but we are deemed to have disposed of the full 25%. Okay, so that extra 5% is deemed to have been sold for the market value of 290, then deemed to have been reacquired immediately at the market value. Okay, so just take note of that. You'll see the implications when we deal with the disposal. Okay. Additional information. The Cooldrink Group has elected to present the consolidated profit or loss and other comprehensive income as a single statement by function in terms of IAS 1.99 and to present other comprehensive income net of tax. Okay. It is the accounting policy of Cooldrink to account for investment subsidiary at cost. The accounting policy of the Cooldrink Group include the following provisions. The group has elected to measure non-controlling interest at their proportionate share. The group considers loans and interest thereon to foreign subsidiaries as part of the net investment in the subsidiary. Okay, so that I was talking about earlier. The group accounts for plant and equipment according to the cost model and land according to the revaluation model. Okay, so doesn't play a significant impact when you do the reclassification of investment property from investment property to PPE. Computer equipment is depreciated over 3 years. The group accounts for investment property according to the fair value model. Assume that all income and expenses were earned and incurred evenly throughout the financial year to which they relate, except for income and expenses relating to the foreign loan in the accounting records of Pink Drink. Assume a market-related interest rate of 12% per annum. All group dividends were declared and paid at year-end, except for Slime Water, which declared and paid its dividends on 31 July 2021. The following exchange rates were applicable at the respective dates: 31 August, 1 July, 31 August. So there's the dates. Assume a tax rate of 28% and an inclusion rate of 80%. Assume a normal income tax rate of 30% and no capital gains tax in Mozambique. Okay, so let's read the required. Okay, so the required: prepare. So that's important. When they use the word prepare, it must look in accordance with how a set of financial statements will actually look. Okay, so prepare the consolidated statement of profit or loss and other comprehensive income of the Cooldrink Ltd group for the year ended 31 August 2021. Your answer should start with profit for the year. Okay, so that's very important. So this is extremely important. So remember, if I didn't say this, then we'd have had sales, less cost of sales equals gross profit. Then we'd have other income, other expenses, then we have profit before tax, then we would have taxation, and then we would have income tax expense, and then we would have profit for the year. Okay. So now then they're saying start with profit for the year. So we will start with this line item. So what's important over here, starting with sales, cost of sales, as opposed to starting with profit for the year, the direction of the adjustments would be slightly different. Okay, so you'll have to keep your head up straight when we deal with adjustments. So we will start with profit for the year, then we would have other comprehensive income and include the other comprehensive income line items. And remember, other comprehensive income is a net of tax. So there are two approaches: gross of tax, net of tax. Gross of tax means you recognize the amount excluding tax, and then you have a separate line item for income tax. But if it's net of tax, each line item will be net of tax, and you won't see a separate line item called income tax. Okay, so just take note of that. When they say complete the investment in Pink Drink PLC note to the annual financial statements of the Cooldrink Group for the year ended 31 August 2021 to meet the disclosure requirements of IFRS 359. You do not need to repeat the information already correctly included in the note by the accountant. Okay, so round off all amounts to the nearest rand or Mozambique new medical. Present your calculations per company for the consolidated statement of profit or loss and other comprehensive income. Comparative figures are not, and notes to the consolidated statement of profit, loss, and other comprehensive income are not required. The answer must comply with IFRS. Okay, so that's basically it. Okay, so in the next video, what will happen? We will work through the solution.